Boom.
John, we
Boom.
are live.
Bam. Let's go.
Pow!
Ecom Scaling Show live with a spreadsheet on the screen. Can't wait to run through it.
I'm pretty sure
Everybody,
spreadsheets, I'm actually pretty sure screen sharing spreadsheets is like the cheat code for YouTube views, LinkedIn views, X views. People just love to screen share spreadsheets. It's like the most eye-catching, wonderful thing to watch.
we're gonna see. We're gonna see soon.
Mm.
But everyone, thank you for joining uh another episode of our monthly Ecom Scaling Show live. For those of you that don't know, I'm John Blair, founder of To Grow CFO, joined by my co-host Dylan Byers, one of the co-founders of Aplo Group, and Alan. Uh, Dylan runs a growth marketing agency in the D2C world. I run a fractional CFO firm in the D2C world. We, over a year ago, thought, hey, let's talk about the intersection of marketing and finance and how to scale brands fast and profitably. And that was the birth of the Ecom Scaling Show. If you don't already listen, check us out wherever you listen to your podcast. We're dropping real fun stuff every week. But today, we're doing kind of a live workshop. For a while, we talk a ton about high LTV brands, CAC to LTV. We talk a lot about this in theory on our weekly Ecom Scaling Show podcast. But at the end of the day, putting numbers on the screen, right, is where the rubber meets the road, brings us down to reality. So we went ahead and we mocked up some demo data, and in a template that is very similar to what the Aplo Group uses, what we at Free to Grow CFO use. And we're literally going to go through exactly step by step. How do you do an LTV to CAC analysis? How do you calculate the different metrics? Where do you get the data from? And talk a little bit through what this demo data is telling us, and and how we use this in practice. So to get started, I actually want to start with this distinction of really defining LTV properly, because it is defined improperly many different places, many different platforms. Dylan, I'm going to pass this one to you. What's the true definition of LTV? And then I'm going to walk through some data on the screen to demonstrate it.
Yeah, so I think in the finance world, it's more typically represented in LTV is lifetime gross profit or lifetime contribution margin, aka the value is the profit you make after your variable expenses. So anytime you're talking about CAC to lifetime value, typically, let's say you have easy math, 50% gross margins, and you have a lifetime value in the first year of $300, and you spend $100 to acquire a customer. That's a CAC to LTV of 3x in year one. That would be a phenomenal outcome. So maybe that's a little bit uncommon, but the other variable would be like what it, how it would be reported in Shopify most traditionally, or like similar platforms, is if you have 50% gross margins, your 12-month LTV may be 600, but because again, LTV should be on a profit basis, it's actually only 300. So I think that's where it gets a little bit mushy. So just to kind of give some like cheat codes for what typically gets stated, there's LTV. That should be, one way of looking at it. Some other people might call it LTGP, lifetime gross profit. Some people call it lifetime contribution margin, or LTCM, if you want another acronym. And I think what most of the software platforms typically report on is probably more accurately stated as lifetime revenue.
Yep.
But they frequent
LTR.
LTR, but they frequently get stated as lifetime value. So again,
Yeah.
just like super important distinctions there. But I hope that was a concise way of going through four different acronyms. Back to you, John.
Who's the finance guy here? No,
Ah,
but no, but we're gonna look at the data on the screen now. So typically, if you're looking in Shopify or Triple Whale or Lifetimely, I don't know, some of the common platforms where people are looking at cohort data. If you go change the metric, you can look at different metrics, right? Well, I'll use Shopify as an example because it's quite common. You can look at this cohort view of retention rate, churn rate. What I always like to do is go to what Shopify calls amount spent per customer, right? Ultimately, revenue per customer. So this is what Dylan was calling LTR, or lifetime revenue. A lot of people mistakenly call this LTV. It's not. Why? Because you don't keep all this. This is not the net value to your brand of this customer. You have to re-express this in margin dollars. And this is margin dollars effectively subtracting all your variable costs, landed product costs, shipping and fulfillment, credit card and merchant or gateway fees, not including ads. And the reason we don't want to include ads is because we're going to compare this lifetime value in margin dollars before ads to the ad spend cost per customer that you spent to acquire a customer, which is also called CAC. So I'll go a little bit ahead here. This is cumulative revenue per customer over time in this demo data set. If you scroll down here, you can see a contribution margin. We can change this. We can say 50%, 35%. And what this effectively does is it converts this revenue per customer to a margin dollars per customer. And again, this 35% should not include your ad spend. That should be your margin after landed product costs, shipping, fulfillment, and credit card and gateway fees. This is actually your lifetime value on average per customer in each of these cohorts, expressed in margin dollars, which is what? The number of dollars you actually keep. And now, it doesn't mean that LTR, lifetime revenue, is pointless, but it is not used in the comparison. You do not compare this number to your CAC, what you paid to acquire that cohort. What I see oftentimes, look, back in the kind of COVID days, pre-COVID, there was this, I still hear this. I talked to a brand recently. It's like, oh, our LTV to CAC is 3-to-1, so we're good. And I'm like, whoa, LTV, he was saying his average spent per customer, right, was 3-to-1 compared to their CAC. That doesn't really tell me anything, because for one brand, if you have a 3-to-1 LTR to CAC in month 3, and that brand's contribution margin is 33%, that's break even. You could have another brand that has a 67% contribution margin, right? And that's actually profitable in month 3. So you actually have to convert it to margin dollars, but then the next thing is you have to bring timing into play. What month? LTV has to be time bound, right? It has to be expressed in margin dollars and time bound. So when you say my LTV is $100, you can't just say that. You have to say my 3-month LTV is $100 for the cohort acquired in June of 2025. So that's a little bit of schooling on LTR versus LTV. Now let's take a look over here at CAC. Dylan, can you define for the audience what is CAC and how is it calculated?
Yeah, so typically CAC will be calculated as the total spend on advertising. Generally, you don't want to include like agency fees or like marketing department salaried people. Like, this is truly just variable expenses on advertising. Could be Meta, Google, podcast, affiliates, so on and so forth, divided by the number of new customers you acquired in a given month. That's going to give you your CAC.
So if we think about this now, look, sometimes we talk about this on the Ecom Scaling Show a lot, and I actually talk to free to grow clients and prospects in this manner as well. I always say NC CAC, new customer CAC. Now,
NC CAC.
I don't think you necessarily have to if you know what CAC means, if you know that CAC specifically applies to ad spend to acquire a new customer. But for sake of clarity, we always say it's the cost to acquire a new customer, NC for new customer, CAC, just to be ultra clear. And it's because the world of D2C is just littered with acronyms, right, that get very confusing, and you can talk to 2 different people who have a different definition for those things. Now, what is important, I'm going to take this a step deeper here so now we have this is LTV. This is your amount spent per customer times your margin before marketing, right? So we've got LTV LTV per customer on average for all of these different cohorts. And now we have CAC, ad spend divided by new customers acquired in a given cohort. What do we do now that we have LTV to CAC? one of the first things we do is we assess when each cohort is breaking even, or what you'll oftentimes hear people call the CAC payback period. CAC payback period is kind of a fancy phrase for how many months does it take for you to recover a given cohort's CAC in margin dollars. So let's look at a quick example here. So this is actually a good one. I'll make this a little bit bigger. This cohort in February of 2025 spent $72.10 per new customer in ad spend. You can see the green is conditional formatting that signifies when has that cohort paid for itself in margin dollars, paid for its CAC. You can see here in month 5, we have accumulated $72.60 of margin by month 5. So what does this mean? If you look at the profit of that cohort, 72.60 is your margin dollars. You subtract 72.1, so you've actually made 50 cents, right, on that cohort by month 5. If you continue to go out to the right, you can see by month 12, we're at $121 versus 72. So now you've made almost $50 of contribution margin after ads on that cohort. So this green, when you see green, that cohort has paid for itself by that month. If it's white, it's that cohort is still lost money. Now, Dylan, from a marketer's perspective, just looking at this scenario, this is hypothetical. I've messed with some of these numbers. It's not real data. But when you look at this, what are you seeing as a growth marketer in some of the trends of CAC to LTV and payback period, and where does your mind go?
Yeah, I mean, it depends on the month that you cherry pick here, but directionally, if by month 12 you have many cases where you're getting in excess of $120 of lifetime contribution margin, lifetime value, especially in many of these months where you have CACs in like the $60 range, like a 2-to-1 in year one is phenomenal in terms of the return. Now, as you scroll down into the more recent months, the hypothetical CACs get a little bit worse. So you have to start, thinking about what is my CAC to lifetime value actually going to be, and is that still a good return for me? I think there's like a few different things that matter here. I think that over the long term, CAC to lifetime value is more important than CAC payback. But if you have a long CAC payback, it can cause cash flow difficulties and actually financing growth. So typically what happens in brands when CACs go up, especially if you're a high LTV business, like in this hypothetical, the way to actually grow is to use strategies to improve lifetime value so that you can have and maintain a less favorable CAC as you scale. And, obviously you're always trying to get CAC to go down too, but, it's kind of like the natural force of gravity. CACs tend to go up over time as you spend more money on ads. So when that occurs, you may end up kind of pushing back your payback period, but normally the way you get LTV to go up is by improving a subscription program, increasing the take rate into that subscription for new customers, and then retention strategies. And it's usually in that order in terms of leverage. And the thing about subscriptions is sometimes they can cause CAC to go up, but you might be able to get 2 or 3 times the amount of value out of a subscribe and save customer than that of a one-time purchase customer. So a lot of brands playing the high LTV game are hyper fixated on order one sub and save take rates, because they may know that it may push their CAC payback from 3 months to 4, but it may increase their retention and value long-term a ton. So I'd say this hypothetical business looks relatively healthy. There's some concerns with the CAC trends, but depending on what their current subscription program looks like and what the take rate is, that's probably where the leverage is. Unless, of course, they already have like 80% sub and save take rates, in which case you probably have to start thinking about deploying a different strategy. But that's kind of the high LTV game in a nutshell.
Yeah, so there's something else I want to draw out and get you to expand on. So if you listen to the Ecom Scaling Show, one thing we talk about a lot is, this is generally speaking, you kind of want to see your payback period somewhere between 3 and 6 months, generally speaking, especially at the beginning of your journey, right?
100%.
The beginning of your scaling journey, you don't have as much. Well, let me demonstrate this. Let's say that we're just getting started down here, right? The brand has just started. As you can see, in the last several months, we've only reached profitability in 2 out of 8 cohorts, right? And it's also like a pretty meager amount of profitability. It's small, right? And so if this is, you combine the margin dollar impact of all of these cohorts and you've only existed for the last 8 months, you don't really have much in the way of cumulative contribution margin. You are going to feel that, and you're going to have to finance that with some sort of equity cushion or some sort of capital base, right? But now let's say you have existed as long as this hypothetical brand, and you go out and you see where some of these LTV numbers sit out in in year 2 and beyond. You now have some of these older cohorts that continue to show retention and drive contribution margin that the analogy I always use is layers of a cake. You've got more layers of the cake of contribution margin on old cohorts that can be used to potentially finance these newer cohorts that have not reached profitability yet. So I want to distinguish, and this is where I want you to jump in, Dylan. I want to distinguish the difference between a payback period at the beginning of your journey, because you have to finance like recent and new growth, versus a brand that's been around for many years and continues to have decent retention in year 2 and year 3, and how they might be able to think about their payback period differently.
Yeah, I think that's totally the case. I think that like this analysis is important because it's a good basic understanding of what your return on investment into a customer could look like over time as you model it out. But the actual more difficult thing to do is, once you have this data, how do you go and actually action a growth plan? Because the reality is that if you're acquiring customers at a loss, there's actually a relationship between that and how fast your cohorts compound on each other, that it can actually set the max growth rate that you can grow as a business without using outside capital. Because if you have to naturally wait to get paid back, even if you have that return customer cushion because you're already doing 5, 10, 15 million a year or whatever, that cushion naturally only grows so fast too. So it can only finance the loss on acquisition at the rate at which it increases, unless you're willing to temporarily reduce profits to speed up a growth curve or something. So how you actually, to your point, kind of compress all these cohorts historically into one to forecast your return customer revenue is the game of then understanding how much contribution margin gets created there that you can afford to spend on CAC on the front end. So I think that like if you're trying to look like super, super high level, this is a great report. And it also gives you an idea of tracking improvements. Like, are you actually improving your CAC to LTV over time, or is it getting worse? Because if it's getting worse, that's not necessarily the end of the world, but it may be an indicator that you may have to start looking at ways to improve it. And then the next step from here in our experience is basically like, how do you actually start layering that cake together? Like you said, I'm not sure, John, if you have any like best practices for going about that, or what you kind of think is most critical in that exercise. But yeah, curious your thoughts there too.
Yeah, so a couple of things to add. One, I always like to use the king of analogies and metaphors. I like to use the analogy of a seesaw to illustrate what Dylan was just talking about. The faster, and one side of the seesaw is new customer loss, and the other side of the seesaw is returning customer contribution margin, right? So the faster that you have returning customer contribution margin coming in the door because of previous cohorts' continued retention, the faster you can lose money on new customers by pushing ad spend at a higher CAC and pushing your payback period out, but it's getting paid for by that, what Dylan calls LTV velocity, right? If that LTV velocity slows down, you likely have to slow down the new customer loss acceleration and get the seesaw back in balance. If you don't, you will have to pull capital from somewhere else on your P&L or balance sheet to continue to fund that. It's not infinitely sustainable, self-sustaining. Additionally, one thing that I know you guys like to look at, and we like to look at as well, is look at on an absolute like total margin dollar basis. Look every month at how the new customer loss in total negative margin dollars, right? And the returning customer contribution margin and total contribution margin dollars every month, how those things are trending. That kind of gives you a sense of the seesaw, how imbalance or out of balance it is at any given point in time. I will say, in terms of how aggressively you can choose, how aggressively you can have the seesaw go out of balance and push faster on new customer loss than you're getting in LTV velocity, it really is generally more of a balance sheet game. Do you have capital, either in the form of retained earnings and or debt financing, that can plug that gap? But there's some serious risk considerations there, right? The further you push out that payback period as you kind of steepen the new customer loss, the more that you are placing a bet, right, on the fact that your retention, your historical retention curve, or your forward-looking retention expectations are going to turn out to be true. And so there's another step that, well, there's another step that I want to go to, but I just want to show another view of this. This is none of this is right or wrong. This is just helpful to kind of look at. Is you can also look at this from the perspective of effectively what you've generated relative to your CAC from kind of like an ROI perspective. It's another view of it. But I want to go to this sensitivity analysis, because going to what I was just talking about is like, if you're going to take a steeper loss, right, because you're going to let CAC float up and you're going to push ad spend, you're betting on your retention or your LTV expectations. So one thing that we like to do, and this is like the kind of the simplest version that I could put together for everybody here, is like, this first takes your actual historical LTV and margin dollars and your historical CAC for each cohort. Then what it allows you to do is do some, what we call in finance, sensitivity analysis. In layman's terms, what if analysis, what if scenarios. And it allows us to say, okay, we think if we scale ad spend further, we're going to increase CAC by $20. So we'll call it, 25%. CAC's going to go up by 25%. If LTV historically remains the same, you saw those green payback or, break even bars move. This is where all of our historical cohorts would have broken even. You can calculate averages and things of that nature to get a sense of what your retention expectations would be if LTV stayed the same, and where these cohorts at a 25% higher CAC would break even. But then you can go in the other direction and say, what if we screw up? And what if LTV goes down by 20%? A good example of this that we've seen before is brands that in the early days before they started scaling paid media, they're like there's a micro influencer that was the founder of the brand. So they have this heavy organic following, and it's this cult following of people that have been following this person's content for a long time, maybe reading their books. And so retention's really strong. And when they turn on paid, historical retention and historical LTV cohorts can actually mislead you, because paid media cohorts generally tend to be a little less sticky. So we can go in here and say, okay, what if LTV goes down by 25%? And then we can go look at where these payback periods would get pushed out to. And so we can use these sensitivity analyses to run these what if scenarios to determine how much risk we're ultimately willing to take on the bets that we're placing of increasing our new customer loss given some sort of an LTV or retention expectation. Is there anything you would add to this, Dylan, on the sensitivity analysis side? Because I know you guys do a lot of this too.
Yeah, I'd say it also can flip the other way. So, like, one of the most common growth strategies we'll deploy on a high LTV business when we look at it is, again, like, if you think of it as leverage. Let's say your first order AOV is $50 and your lifetime value is $200 to $300. That means that the vast majority of the value is created after order one. And when that's the case, you're super incentivized to try to increase retention. And usually the biggest way to increase retention is to increase sub and save take rate or retention strategies. So as you actually change some of those metrics, you can also forecast to the upside, being like, okay, I've changed my sub and save take rate from 30 to 60%. I know subscription customers are worth X percent or X dollars to me. One-time purchase are worth Y dollars to me. I'm going to build like a simulated cohort with a new blended average. And because of that, I want to estimate or forecast to the upside. Now, I think this gets into like a whole other can of worms where it's like anytime you play the retention game, you are to some degree betting that the future will look like the past. And in
Hmm.
most cases, in most categories, it does, especially consumables. So, when you do some of those like simulated cohorts, you may want to like do a simulated cohort and then also adjust, like pull it forward and then also then pull it back a little bit because you're like, like I am making some speculations here. It's data driven, so I'm very confident in it, but I want to balance that risk. The riskiest category for LTV game is typically clothing and apparel, in our experience, because typically it's very drop based and styles change depending on the category you're in. So that category, the LTV looks a lot different and is a lot slower to actually compound. So typically when playing that apparel game, it's just important to be mindful of the fact that you probably, most of these brands are break even ish, anyways. You like to say they typically don't acquire at such a steep loss as like the consumable kind of high LTV subscription brands. But that's just another thing to be mindful of is like how consistent are your cohorts? Some of these
For sure.
subscription businesses we see, those cohorts are like practically like the same after every single month. It's just like they just churn out the same performance. Whereas in some of the other categories where it's not subscription based and the product mix changes a bit, there's a little bit more variability. So you may just
For
want to
sure.
take that into account when underwriting how aggressive you want to be.
Yeah, and look, just let's look at some of the data really fast here, right? It's really easy to see that this is not adjusted. Oh, let's move the CAC back. You just look at the LTV in any given month, right? And I like to just scan up a given month's column, and you can see there's a little bit of variability, but it is operating within a pretty tight band, right? And then you get to the next month, same thing. And so there's something I thought of as you were talking, Dylan, that I want to mention is that, like, look, one of the things that I really love about the high LTV game, you can run a sensitivity analysis and you can place a bet, right? The good news is you should do this analysis every single month. So you can place a bet on a given cohort, right? And you can see how did month 1 do? And then when you get to month 2, how's month 2 doing? How are we doing month 3? Within a few months, you can figure out if that cohort behaved it appears to be behaving the way that you thought. And if it doesn't, you can switch your ad spend strategy and go back to what you were doing before, right? And at some point, if you have decent retention, that cohort will earn a profit for you at some point, most likely. And so it's not a complete wash. It's not like one thing we call the new customer dominant game, like durable goods, no repeat purchase. If you acquire someone at a loss, it's done. That customer's a loss forever. There's no way to recover that, right? And so the only thing you really get to recover maybe is the cash flow that you outlaid for the cost of goods sold, which is a cash inflow, but at a negative P&L profit or negative contribution margin. So just keep in mind that I guess the point I want to make is like this is not a set it and forget it. That's another really common mistake that I see is people pull this open and they'll calculate these kind of like summarized metrics. Where are we at by month 6, month 9, month 12, and they're like, that's my LTV. And then they don't check it again for another 12 months. And you can't do that. This is a dynamic, living and breathing game. And the fun thing is every single month, when the month is over, every new cohort has a new data point for you to look at, right? And so it's not just the most recent cohort. You can continue to make sure that retention further out on the retention curve is continuing to behave the way that it always has. So it like, if anything, there's too much data here and it can get overwhelming and you're like not sure what you should look at. But there's always something to look at and at least confirm, if not adjust, from your
Yeah.
cohort data every single month.
Yeah. I think there's two other things. I'll touch on one thing you just said, then touch on another framing of this that can sometimes help decide how good your cohorts are. So, firstly, you touched on like always checking this. I'll go back to like another growth marketing strategy that typically gets deployed and the nuance to how you have to check. So, let's say that typically you've sold a product where it's one-time purchase price is $50 and to subscribe and save it's 10% off and it's always 10% off. one of our favorite strategies to deploy is say, okay, we're actually going to increase the discount on subscription on the first order, but reduce it on the recurring orders. Why do we do this? Well, normally the biggest variable for increasing sub and save take rate, other than just having a subscription only offer, is to increase the discrepancy in price between one-time purchase and sub and save on order one. The recurring orders don't matter as much. So when you do that, what tends to happen is you will increase your sub and save take rate, but the retention on those customers may not be as effective because they haven't proven yet that they can and are willing to pay the full standard subscription price. So you'll sometimes see higher subscription churn when you make that implementation. So you have to make sure that that's still worth it. The reality that's usually far worth it because it's normally like marginally worse when you say go from 10% to 30% on first order and it renews at 5. And the reason why is basically like, even if you say like take your sub and save take rate from 10% to 40% as an arbitrary example, doing that change, even if the retention rate on those first few months are like 5 to 10% worse, the value of subscription customers for most brands are so worth it that it's still an incredible ROI on making that change. So you have to actually make sure that the first 2 renewals are still in a healthy range. And to your point, once you kind of get to that 3rd, 4th renewal, typically those cohorts should behave very similar to the historicals because it's functionally a very similar customer at that point. They've shown they can actually pay that price. So that's a prime example of doing that. The other thing I like to look at, if you want to kind of simplify it in some ways too, is also just think about it as like annualized return on investment into a customer over time. Like a fun exercise to think about is like, as a business owner, you're deciding how much you want to pay to acquire a customer. And you can kind of do the math of like, okay, like what could an index reasonably return? What could XYZ reasonably return? What can my customers reasonably return on an annualized basis? And that's another fun metric to track. I at least like to track because I think it's like, whoa, like, you can get 5, 10, you just love talking about finance. You're happy right now, but like, so I can get 5, 10, 15% over here. Look at this. I'm getting like 40% a year over here in these subscription funnels. So like, I love looking at that. It makes me happy.
Yeah.
It's a big smile on my face.
So one other thing I'll point out too is like it is helpful sometimes to look at summarized versions of these metrics. We could go into a bunch of these, so I'm not going to spend any more time on it. But since I talked about that bogus 3-to-1 LTR to CAC like myth that still somehow shows up today, this is actual LTV and margin dollars to CAC for this hypothetical example. And there's a few checkpoints kind of every 3 months for the first 12 to see on average how you're doing effectively with recovering your CAC, right? So by month 3, this example is showing that this is almost break even on average across the board, right? Then we're at 1.38 in margin dollars versus CAC by month 6. And by month 12, we're double. We've basically doubled in margin dollars, the investment in CAC. And then if we go out to month 18, we're at 2 2/3. And so this would be interesting to look at month 24 as well and see, but like you can even see what's the 19, 20, 21, 22. So they're actually at 3-to-1 by month 22. So it's helpful to look in summarized terms to get a higher level view of kind of like what is your ROI on acquisition, right? So anyways, this is a lot of fun, man. If there's anyone who has any questions, drop them in the comments. I've got a couple more quick things to say, but we're here to answer any questions if you do have any. Dylan, what is your final thought? We talk a lot about high LTV brands and what we call the high LTV game, but given that we've been able to actually show some data on the screen and go a little bit like step by step, how do you do this? What's the major thing you want everyone to take away from today?
I would say that the high LTV game is not the majority of D2C brands. Like it does not represent the majority of brands, at least that we talk to. But it's a game where when you interact with other ecom brands, if they are not playing that game, the advice that applies to them is like often not good advice for you. We often summarize things into 3 games. So it's like high LTV, high SKU count, and durable. High SKU count and durable have a lot of the same kind of like best practices. High LTV is just a different beast. And it's not to say ads don't matter. They totally matter. You always want to try to drive down CAC, and they especially matter because you want to ideally drive traffic into the places on your site or into the products that create the most lifetime gross profit or lifetime value. But I would say that in that a high LTV game, you really want to make sure that you're like almost like over indexing your focus into retention as a strategy. Retention does not only mean email and SMS, it means your subscription program optimization. It even means how you structure your offers to be built to maximize customer lifetime value. And I think that my biggest recommendation is like, because I know a lot of people like to spend time in Ads Manager, as do is I think oftentimes the leverage exists outside for this specific category in DTC. How
Yeah.
about you?
I guess I'll build on that with my final thought, which is like, look, these numbers are important. You have to know them, you have to analyze them, and you have to take action based on them. But how you improve them, right, is in very practical ways, like improving your gross margin, right? Going and figuring out how to get your variable costs down, figuring out if you can price your product higher, figuring out if you can raise your AOV, right? Work the retention side, improving your email and SMS and your retention tactics. It's going out and doing things in the business to move the needle on these numbers. These numbers tell you where you have a problem or a trend going in the wrong direction, but you have to take action in the areas of the business that you believe are going to drive those numbers in the right direction, and that's how you fix them. The data doesn't take care of itself. So I think that's my final thought. Does anyone have any questions for us? If not,
I think we
we
may be
will.
all good, John. I think this was the stream. Thanks
Sweet.
everyone for tuning in and see you next time.